We've got a GDP ranging at about 67%. Why do we have very low inflation while we have a solid growth? We're seeing vegetable prices are cheaper by about 25% than a year ago, but gold, which has jumped nearly to 58% in a year, there has been a one-time impact of GST, which has had an effect on the overall mass consumption. Official consumer inflation in October 2025 was just 0.25%. This is the lowest that it's been since the index was launched way back in 2013. Now, less than a year ago, the inflation was above 6%, which is breaking the 2 to 6% band that RBI has set around the 4% target. We've gone above the top of the danger zone and almost to nearly zero in a record time. The economy is growing fast. We've got a GDP ranging at about 67%. So why do we have very low inflation while we have a solid growth? And the fact of the matter is that this is a scenario where that every financier, anyone who's from the debt markets, even a finance minister, all of them love this scenario. But the natural question here is, should the RBI now cut interest rates sharply, which makes money cheaper for everyone? Or is there something a little bit more deeper that's at play here when we look at the inflation data? So what actually caused inflation to drop to an all-time near low for the Indian markets? Well, there's no single answer. We've seen a few reasons for this, and there are about three reasons specifically. One is the food prices, the second is the tax changes, the GST changes that happened, and finally we'll also look at plain old statistics. So food prices went from a period of a lot of pain, essentially being deflationary in essence. Almost half of the consumer bucket, which typically forms a big part of most family budgets. Last year, vegetables were roughly around 30% more expensive. Pulses were rising at phenomenal double-digit rates. We also saw rice and many staple products also being quite expensive. This year, the picture has changed. We're seeing vegetable prices are cheaper by about 25% than a year ago. Pulses and grains and staples have also seen significant declines, and we can see that happening across the board with onions, tomatoes, dal, etc., which were burning the savings or the earnings of many people last year. That is not happening right now, and the reason for that is that inflation is quite low. And this is partly to do with the fact that we've had a very strong monsoon this year. We've had good kharif crop, which means there's been bumper harvests. There's also been a policy from the government that's been at play where we've seen duty cuts, imports of pulses and other grains along with edible oils, and onions have been released from the buffer stock. So that's pushed a lot more food into the system, which means prices have naturally come down. For consumers, this is obviously a relief. The second part is the GST changes that happened this year in September 2025 when they were rationalized. And what this meant was that there was a lot of rate cuts that happened across the board on many mass consumption items. And that has shown through the data and through the analytics that we're seeing over the next few weeks post the GST rate cut. And this happened across the board on clothing, footwear, household items, consumer durables, all of these items that typically these items that we use to sort of measure inflation, those are being pulled down. So core inflation, which typically ignores food and fuel, that is sitting roughly between around 4%, 4 to 4.5%, which is higher than the headline number. But gold, which has jumped nearly to 58% in a year, is also sort of grouped inside the core index under personal care and effects. So that one item, specifically gold, makes core inflation look much more stickier than it really is today. And if we remove gold, most of the core products, most of the core goods are roughly flat or slightly marginally up. Services like housing, health, education, all of these are growing in low single digits. So this isn't a world where everything is suddenly cheaper. It's more skewed towards the fact that food is sharply down, certain GST cut items have gotten cheaper, and services are gently rising while gold has been increasing. Finally, from a statistics perspective, in October 2024, inflation was above 6%. When you compare that to today's prices, to that very high base, the change looks unusually small, and that's the base effect. So part of the inflation crash is real. Food has fallen, taxes have dropped, and part of it is arithmetic. Even slow price rises now look tiny when you compare it to the last year's spike that we saw. So the 0.25 headline inflation number that everyone has sort of been talking about is a mix of actual disinflation and sort of a flattering comparison compared to where markets were and inflation was last year. So why do you feel prices are still high as a consumer? Well, on paper, inflation has nearly disappeared, but when the RBI typically asks households what they feel, they say that the current inflation feels roughly over 7% and could be headed higher as well. So there is a gap and an expectation gap that's there between the official number that's being reported and the sentiment that the broader mass or the broader market is feeling. And that's a huge delta. So why is this happening? Well, one, we have older households that remember the very high inflation periods of the early 2000s and 2010s and potentially the post-pandemic spikes as well. Second, you typically remember the month your milk price may have gone up or your school fees jumped up, but typically you may not notice when a basket of goods such as your tomatoes, onions get cheaper. So pain is more stickier and relief tends to sort of slip away. Finally, the media also amplifies price spikes and not just sort of slow declines. So this results in two parallel realities. The first is that in the data, inflation is nearly zero. But in the minds of people, there is a high and rising inflation. They feel that the prices are rising. So all of this matters because it shapes how interest rates are going to sort of move in the near future. With inflation currently at around 0.25 and the 10-year government yield hovering roughly around 6.5%, the real interest rate, which is the difference between the yield and the inflation rate, that interest rate is close to around 6%, which is one of the highest in the world. So savers who were invested in, let's say, fixed income assets are going to love that, and borrowers on the other hand are going to hate it because they have to pay a much higher fees in terms of interest. Capital is expensive, especially when you compare to countries where inflation has roughly been around 3 to 4%. And long-term rates aren't much higher than India's. So we now have near zero official inflation, very high real interest rates, and households that feel inflation is closer to 7-8%. So what does the RBI do in that scenario? Does it cut interest rates or should it do a holding period strategy? So given where we are today in inflation terms, the rule book would say that RBI should loosen policy so that inflation slowly drifts back up towards a 4% target that RBI has sort of maintained or targets to maintain, which means that the rate cut is imminent. Cheaper money would mean, reduced borrowing costs, supports investment and consumption. It makes loans on car, home, personal, consumer, etc. much more affordable for people, while the low inflation will also help protect real incomes. But there is another risk, which is that there could be a low inflation mindset. So if people start believing prices will stay flat or that they will fall, there could be a delay in making any significant purchases or significant investments, and over time that weakens demand, and which makes it harder to push inflation back to the target range. And this is something that we've seen in Japan, we've seen it in Europe, and this is something that many economists are saying, it can keep real interest rates very high and inflation near zero, risks sort of pushing the overall behavior in that direction. So that's the case for cutting interest rates right now. But there is a significant counter argument, which is that there is a case for waiting and being patient in cutting rates. So today, with low inflation, heavily shaped by various temporary factors, we've had a good monsoon season, which has led to a good harvest. There has been strong policy from the government to manage the food supply. There has been a one-time impact of GST, which has had an effect on the overall mass consumption cycle. And there is also this flattering base effect from a statistics perspective that we spoke about. So as all of these sort of fade, we could see prices bounce back faster. Now, growth and GDP numbers have looked very strong for India. Public investment has been high, tax revenues are looking solid, and urban and rural consumption is holding up. So this doesn't necessarily look like a scenario where the RBI may want to cut rates, given that the economy is not in a zone of demand sort of falling off. Cutting rates could actually push up asset prices because it could lead to more speculation in gold, property stocks. It could also confuse people about RBI's priorities. So the global backdrop has also been a little shaky. We've seen higher tariffs on Indian exports, patchy growth around the world. There is a risk of spike in oil and commodities, which can all lead to significant impact in the inflation numbers and sort of having that inflation effect coming in faster. So the dilemma for RBI is simple. You cut too fast and you risk your credibility and potentially higher inflation later on. But if you wait for too long, you could risk falling into this low inflation trap where there could be weak private demand, there could be super high real rates as well. India has spent decades fighting this high and very volatile inflation, which has kept interest rates, real interest rates as well, very high and little room for the economy to respond to major shocks. Right now the mix is a little different. We're in a low inflation, decent to strong growth, and strong sort of ongoing reforms that are coming in from the government to turn this into a genuine advantage that could amplify the Indian economy. There are three things that ultimately matter. The first is strengthening the food and supply chains across the board, which could mean investing in more logistics, cold chains, storage equipments, farm productivity, all of those things that can keep food prices less volatile, less wild, and ultimately help control inflation better. The second is more stable policy from the government. GST rationalization was a smart design and has obviously given us a one-time kicker in terms of both growth and boosting the economy and the consumption. But continuous tinkering of policy can make it very difficult for businesses and obviously markets to sort of respond to that on and off. Third, RBI also needs to sort of strengthen not just its models in terms of how they are predicting and forecasting inflation rates, because they have been quite off the mark, but also how they're communicating it to the markets, to households, etc. And potentially even the baskets that they're considering in the inflation index that they've been capturing. And all of that has to happen from the RBI so that there is a sound financial system where the policy that the government is making and that RBI may be doing through monetary policy changes actually goes to the end borrowers as well. So what does this mean for you? Well, India is in this near zero inflation zone. Well, is that a miracle or a warning for you? Well, it's a little of both. It's a miracle because the country has been used to such high inflation historically that there is some breathing space and some relief from a food inflation perspective. It's also a warning because that small tiny number hides a lot of stress from rural perspective, the very high real interest rates that we spoke about, and a central bank whose models don't seem to be fitting or understanding or predicting how inflation can shape out in the future. And that sort of overestimating of the expected inflation of the market can also change. So RBI's next few decisions is what will shape whether your future EMIs genuinely become cheaper for you or whether your salary grows in a stable low inflation world, and whether India really locks into a much healthier long-term path. We hope you enjoyed today's video. If you want us to cover any more topics, do let us know in the comments below. Do like, share and subscribe. It really helps us out. Thank you so much for watching and happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.